You're now listening to Cashed In.
Welcome everyone to Cashed In, episode 11. I'm going to be solo today as Anna is actually on a flight to California. But I'm lucky to have a guest with us today that I know very well, Dustin Fannin. He is a mortgage loan officer with Union Savings Bank, located right here in the South Hills of Pittsburgh. And I've worked with Dustin quite a bit. I've referred quite a few customers to him. One thing I can say is that in terms of his level of intellect around just different mortgage products and loan products, he's also very well versed across a variety of different topics as it relates to real estate in general. Well, so welcome, Dustin.
Thank you for having me, guys. It's nice to be here, and I appreciate the praise. It's always fun to have a conversation with you.
I think the last deal that we had worked on was right at the height of the pandemic, right?
Yes, yes.
A lot's changed since then, right?
It has. So I think it was a deal up in Beaver that we were working on, if I remember correctly. Midland property.
Mm-hmm.
Yep. 5 unit, something.
6
like
unit.
6 unit.
Yeah.
6 unit. Okay.
Yeah.
So that product that we were using for that was a 5-1 ARM. Was that
We're using adjustable rate mortgage.
Rate mortgage, and I kind of wanted to touch base on that today with you and your viewers.
Mm-hmm.
That product is something to not be feared. A lot of people fear the adjustable rate mortgage because they're afraid as soon as after that 5-year ends that all of a sudden their interest rates are going to go up, to whatever the bank wants. And in reality, it's not what the bank does. It's based on what the market is at that time. So, for instance, our non-owner occupied adjustable rate, for instance, was 3.5 a few days ago. So, if you were on a 5-1 ARM 5 years ago, and your rate was 4.25, for instance, you would get to 5 years now. It's now down. Your rate wouldn't change. So
right.
You really have it would just get recast back into the loan and you're still paying out your amortization schedule. So that right there is something that, when you're delving into it, it might be a better option in this current market where fixed rate mortgages are skyrocketing through the roof.
Right.
You might want to find an adjustable rate mortgage and then maybe refinance it down the line, or you may not even have the property for 5 years, for instance, if you're an investor. A lot of 7 to 10 years usually is about how long you hold on to a property.
Mm-hmm.
So I guess I just kind of want to touch base on what that product can do. That product gets around a lot of the Fannie Freddie type stuff, and every bank is different, right? Some banks offer 10-1 ARMs, some offer their 20-year fixed ARM. That's a weird product, being that it could be a 20-year fixed as well. But you can go all the way down to a 1-1 ARM, which is a 1-year fixed period. And those rates are usually a lot lower.
Probably a lot lower.
Yeah. I mean, you could get anywhere. You can get in the 2s right now on a 1-1 ARM. And that right there is very appealing to, a lot of investors. And it is a lot more volatile.
Why would they do that? Is it just because it's
Well, it depends on what they're trying to do with the product.
So if they're going to hold it for a short period of time?
Right.
Is that what they're...
It's exactly right. So like our blanket loan, for instance, is a 1-1 interest only ARM, meaning they're only going to hold the blanket loan for 1 year. The idea is that hopefully they, get out of the blanket loan and into a different product that would better suit their needs. That's all it is, really, is finding the product that suits what you're trying to do. And not every bank's going to offer every product. Not every bank is going to meet every need. Most banks you're going to run into, they're going to be like, yeah, we do, VA, USDA, conventional, they all do that, right? Every bank does that. The banks that you're going to be trying to hone in on are the ones that are going to take care of you, and the ones that are going to answer they're going to answer your call. They're going to try to, work with you, try to figure something out. Try to look at their suite of products and see if it's going to fit what you're trying to do. What type of property you're trying to buy? Is it in Florida? Is it in, Pittsburgh? Is it in, wherever it may be, LA, something like that? Depending on where the location is, that may limit what those banks can do. So when you're looking to buy in those types of different areas that isn't your normal location, you might want to look for a local bank that does something along the lines of portfolioing and keeping the product in their own house. And that might help benefit and help you in the long run in terms of what you're trying to do with your own portfolio.
Sure. Yeah, no, that's very insightful. So, you had said something that, trying to really align your customer, for example, with a specific loan product that fits their needs based on what they're trying to do, but also based on their financial situation and their income, for example.
Correct.
Right? There's a lot of people that they might not meet the income requirements that you would deem. So what's the current DTI requirement right now?
So the current DTI requirement on such, say, like our ARM product,
regular,
I'll give you an example of ours. It's kind of a floating target, right? It's the strength of the deal more so than anything, right? Say you have a ton in assets. We're more likely to be a little bit more lenient with somebody who has a lot of assets, a lot of experience with investor portfolio type stuff, and we will probably go up to 45%. We like to see it anywhere between, below 40 is ideal. But you kind of got a gray area with your bank when it comes to that situation. But the good news is getting into that debt to income range. We will do certain things like asset amortization, where we will take your 401k, types of accounts that you may not necessarily be using for the closing of the property, and we'll amortize it out to where we can use that as income. Our blanket loan, for instance, uses your exiting primary as it's called rent back, or rental income, that they'll use it even though you're not claiming it. You're not actually going to be renting out your primary. You're going to eventually be selling it on the blanket loan product, but we'll take the going rental income rate on that property and use it towards your income, which is game changing for a lot of people. Sure. Because you're essentially holding two properties that you normally wouldn't be able to hold in that situation. But you can also do that with some of our for non-owner occupied properties as well. We'll blanket as many properties as you want if you're trying to buy a new property. Sure. And we'll use that. Hopefully you've already, you've held the properties for, a couple years. As you know, our bank is very conservative when it comes to those types of things. So,
yeah.
You've experienced that for better or for worse. But,
both, yeah. But so for a newbie, right, that might not have $100,000 in their 401k, right? So the debt to income requirement for somebody like that would what is it, around 50%?
It's still around 45.
Oh, so it's still going to be around 45.
It's still going to be around 45. Yeah. So you kind of, how much money are you putting down, right? That comes into play.
Sure.
If you're doing the standard 20%, you're not going to get as much leniency. If you're doing 25, 30, you get a little bit more leeway when it comes to that thing. But if you're trying to squeeze in there, you kind of want to limit what you have going on in terms of your DTI, right? I tell people, if you've got a vehicle, get it into your wife's name, get it into a spouse's name. Mm-hmm. If it's going to be you that's going to be the investor, the mortgage guy, you need to strictly be mortgages and maybe one or two credit cards. That's your ideal credit profile, so to speak. Having that vehicle could be another mortgage, essentially. Yeah. So, and I see that quite often where people will come to me and, they'll have vehicles in their name that are, it's $500 usually that's pretty average for most people for vehicles these days. But that can be detrimental when it's coming to terms of how big of a property can you buy. If you're trying to break into that investor sphere, you want to get rid of that vehicle, own your vehicle, downgrade, downsize, pay in cash, do whatever you can. It might temporarily be an inconvenience, But ultimately, your end goal has to be, okay, well, I'm trying to own properties. I'm trying to own multiple properties, multiple units. And when you do own the multiple units, the multiple properties, then you can buy the new vehicle in cash. You can buy what you want. And it's just a matter of, you know, sitting with yourself and making a determination of, okay, well, I can suffer for a year or two, right?
Yeah.
You know what I mean?
Yeah,
Like,
for sure.
hey, I could go without the, you know, the latest and greatest.
For
you
sure.
know, maybe not quite the you know, newest you want, but you just, you know, a few years old, pay in cash, take 10 grand, you know, buy a used vehicle, ride that out until, you know, till whenever. But that will get rid of that part of your debt to income ratio that, for me as a loan officer, when I'm calculating it, I'm going to be like, okay, you have a vehicle it's gonna hurt you a little bit, but you also, you know, you want to make sure that you have no missed payments on that vehicle, because if you have a missed payment on that vehicle, the bank's going to look at that and go, come on, man, what are you doing? Like,
right.
why'd you miss this? You
Right.
know, well, they're looking for reasons why. Did you get laid off? Did you, you know, things like that. But ideally, you want to get rid of all your credit debt in order to invest, because you want to be able to open up all of your debt to income towards that mortgage, or, you know, excuse me. You want to be able to open up your debt to income ratio to allow for multi-unit. You know, if you're trying to buy a 300, people are surprised at how little income that you could qualify for a mortgage. So I just qualified somebody who makes $2,500 a month, no debt. She has no debt. So what that essentially means is they qualify for over $1,000 in mortgage, right?
Right.
Okay. Well, you can find a duplex that only is costs $1,100, and then now you're paying your mortgage with the side unit, and you're living in the one unit. That's an easy start to getting into investing. Very easy. Probably the simplest way to do it. If you are trying to, you know, if you already have that debt and you're like, man, well, Dustin, I have a ton of credit card debt already. I have a vehicle, you know, well, find ways to get the vehicle into somebody else's name, right? Your wife's name, or sell the vehicle, you know, and go for a lesser vehicle where it'll open up that debt to income ratio. The key to all of this is your DTI.
For sure.
And
for the conventional Fannie Mae loans, right?
Because, well, yes and no. But that's just because Fannie and Freddie have a very hard guideline on those. You can't get around those guidelines.
Well, if you have like these bank statement loans that are out there, these investor-backed loan products, right? Like these non-conforming products, I mean, they don't really have the DTI requirement. So like, for example, you know, I remember you had told me, you said, look, Mike, I can't get you approved for a $50,000 duplex. You know, you're maxed out. You can't do it. And then you had mentioned these loan products to me, and I'm like, no, I'll find someone else to do it. I just didn't. You don't know what you don't know. Quite frankly.
Right.
So then it took me to when I was purchasing down in Florida. I had to, you know, finagle my tax return to make it meet that requirement.
Yep.
But I was introduced to a broker down there that ultimately. That's what he does. He does a ton of these non-conforming loan products, and it's not about that. They just want proof of funds, and they want to see that you have a credit score over 740.
That's right. That's right.
So you pay a little bit more for them, you know, but in the grand scheme of things, I'm paying for access to be able to do this instead of ultimately paying more or showing more rental income on my return.
That's right. So you also, I mean, this is also why hard money lenders are a thing.
True.
You know, so you have just a suite of lenders out there who are, you know, seeking business in one form or another, who are trying to, you know, get your business, right? And so my bank, like I said, is very conservative when it comes to that type of stuff. But you'll have people out there who are just loose, who are like, no, we'll give you, you know, bank statement loans. Oh yeah, we're good. You know,
it's crazy to actually think about it, because when I was turned on to that, I'm like, oh my gosh, this like seems like, you know, it seems like '08 all over again. You know, they're just giving. Now, granted, you know, I obviously meet the requirements in terms of the funds and the credit score, but you know, it's kind of like willy nilly, you know, where they're just giving out loans, you know, and I'm definitely not complaining about it, but you know, ultimately, you know, I own a good bit of real estate. I don't want to see a collapse either.
You don't. and that would be detrimental for all of us, really.
Sure,
You know,
right.
and you would see another overhaul of a tightening of.
Now, you don't see any of that. You don't see any underlying issues in
No.
terms of the
so
market.
so what you have that's going on right now, right? All these, the housing market is more stable in regards to banks giving out loans to your average person, right? Your average family that's just looking to buy and get into their first home. They're scrutinizing their W-2s, tax returns, bank statements, credit scores, any missed payments. So you're not going to see, and that's the bulk of it, right? That is everything that you're seeing right now, where everybody's in every single competition to buy a home. It's just usually just single family trying to buy a home. A lot of the investor stuff doesn't usually escalate until you get into the multi-units, duplex, triplex, quadplex, and above. But once you get above quadplex, it's adjustable rate mortgages, 20% down, and your average buyer doesn't have 20% down.
Right.
They are strictly going to be your 4 and below. So you're not going to see a collapse in the housing market because it's been scrutinized already to make sure that these people aren't going to have a hard time paying their mortgage.
Right.
A lot of the times that when we go through underwriting, my underwriter will pull me into the office and he'll say, okay, we're going to go over this. We have to, and we're going to sit down and we're going to go through it. And so we sit down and we see, the strengths, the weaknesses, of each file that is a quote unquote problem file. Not all of them are problem files, right? You'll have your couple one or here, and they really, make your hair start to go gray after a while.
Yeah.
But usually your 20% downs, they just go right through.
Yeah.
You just see them go.
It's the
right
less
through.
money down.
It's the less
just
money
because there's
down.
less skin in the game, or
less skin in the game.
DTI, or obviously the payment's going to be higher, so you have to worry about.
You worry more about debt to income ratios. You worry more about credit scores. Remember, FHA will go all the way down to 580. VA will go all the way down to a 580.
Right. So those don't go through that easily?
Those don't go through that easily.
Yeah.
No. I personally have only seen one of my own go through, and they were barely above 600.
FHA?
FHA, yep.
You've only had one? Well,
Barely.
that's not your only FHA.
No.
But that's the lowest credit
That's
score.
the lowest
Okay.
I've ever seen, was barely above 600 go through, and I was quite surprised.
Is that based on the underwriter, though? Or is that very,
No.
it's just a...
So I don't know if a lot of people know this, but there's an automated underwriting system called Automated Underwriting System, AUS. LP is Freddie Mac's Automated Underwriting System, which is Loan Product Advisor, and DU, which is Desktop Underwriter, which is Fannie Mae's. So both of them have algorithms on how they calculate whether they approve somebody or not. You can go on an FHA all the way up to 57% debt to income ratio, which to me blows my mind.
That's crazy.
Because, again...
Low money down, and you have this high DTI, right?
You have a high DTI, and usually those are the people that have a lot on their credit. They have, they're tough at budgeting, right? You want them to be able to budget for the... so for me as a loan officer, I really, really scrutinize that client, because I ask them, I say, okay, this is going to be your payment. What's your budget? What are you keeping for yourself at the end of the day? You don't want to just be house broke.
Sure.
You want to be able to, go out to eat every once in a while, pay for gas nowadays.
Yeah, it's
you know what I
expendable
mean?
cash, yeah.
So yeah, you're going to see, you'll see a change in the market, but you're not going to see anything like it was in 08. That's
so how have you factored in, it was interesting last week, I'd mentioned we had Justin Davis on, who's an appraiser, and it's interesting to see, because you'll see these properties that go on the market, high ask price as is, quite frankly, higher ask price than the property might have ever had before, and then they go for, 20-25% higher than the ask price. Now he's saying that most of these properties they're under appraising, let alone are they hitting that mark. But so in your experience, how are you guys assessing? Obviously, you aren't assessing or evaluating the value of a property, right? I mean, but,
Right. So the appraisal is there's a lot of checks and balances that go into appraisals, and there's a lot of eyes on it. Underwriting is one of them. There's also there's a system that the appraisal gets run through. I mean, the appraisers have to follow guidelines.
So you'll look at you'll evaluate the comps that they're using then
You'll
too?
evaluate the
Okay.
comps, you'll look at the comps, you'll say, okay, well, they use this one, why'd they use this one?
Okay.
So right now you're seeing what happens is, remember, they go back 6 months to a year on every purchase that's a comparable. So you're going to see a trailing value on those properties where, okay, they may not be appraising right now, but they're appraising higher than they were. So a year from then, if any other properties that sell in that similar comp range to the property that you just bought or are buying, that property is going to appraise because you bought one that was higher. And so it brings the value of the properties up overall. Now, a lot of those appraisals, the appraisers themselves, as you probably already know this, that they really look at that and they really are scrutinizing to make sure that they're not just letting the market run away.
Which is, I think that's a blessing. Quite frankly, I had an offer in Ocean City a couple weeks. I was under contract, and the appraisal, I think the list price was 505. I did go 10 over, and I didn't feel good about it, but truthfully, I was chasing it because I knew what the rental income was going to generate from it. The appraisal came in at 450, so it came in way less. The sellers didn't want to. They just said, "All right, well, we'll wait for a cash offer, or we'll just hold on to it." Well, then it ended up going under contract again, conventional financing, and that appraiser hit the mark. And I'm like, how is that even possible that you're able to? And that's what makes me skeptical about it, and it makes me alarmed. Look, I don't want to buy something that's not worth it. Right?
You don't. And quite frankly, a low appraisal is actually a blessing to the buyer.
Yes.
And a lot of people don't see that. They think, oh, well,
I lost it. I got screwed.
I got screwed. I got lowballed.
Yeah.
This appraiser doesn't know what he's doing. So then you have a lot of and the agents are, they get ticked off too,
Sure. They want to get to the closing table.
Everybody wants to get to the closing table. Everybody. I promise you that. That is a 100% guarantee. But they feel, but it's a blessing to the buyer because now okay, well, why did this property sell at this value, but you went ahead and, you matched it. I see why you matched it.
Sure.
Thank you. Now you go back to the negotiating table and you try to see if you can work something out. And a lot of times you can, but at the end of the day, some people are you're like, nope, I'm getting paid no matter what. Well, you're going to see a decline in that. That's coming. That is down the line. That is on its way where the sellers aren't going to be able to say, no, I want this. You give me this. Yeah.
I mean, I've already seen, since rates have gone up, I've already seen some sellers, lowering their price, right? Not to say that the market I think it definitely somewhat stabilized. That's my belief. The inventory is just still so low, and that's really why it's still so competitive, especially in the multifamily homes. There's very few multifamily properties listed right now on MLS.
That's very true. So a multifamily unit is it's a unicorn, so to speak, is what I joke about with people who are who are trying to do the FHA, multi-unit first-time home buyer purchase. And I'm like, look, you can go up to 4 units, but good luck finding one. That's your difficult part.
That's the problem.
A lot of those people that have them, they've held on to them for years. But the good news is that if you find the right bank, and I'm going to do a little bit of a plug here if you don't mind.
Go ahead.
So we offer a product called Spec Homes that we do spec homes for we allow you to build on your own land if you own your own land, and then you parcel it out and you keep repeating and selling. So you're basically building inventory on your land, and you just keep buying and selling, right? So you go and you have a builder builds on your property, house goes up, you sell it, do it again, keep repeating it.
So how much money does the landowner have to have in it, or they're just basically parceling off it?
As long as they qualify for a debt to income ratio and you can use the land as a down payment. So that's your equity
Wow.
and skin in
Okay.
the
So
game.
that's your skin in the game right there.
Yeah. So I
So
mean,
you have to parcel each individual
you
lot
parcel
off?
each individual
So you have to
lot
get approval
off.
and all
Yep.
that stuff. Okay.
Yeah. But if you find that you can do it, so like some people are like, well, I have 20 acres. What do I do with it? I'm just going to sell it for 100,000 or 200,000
Yeah.
or whatever. And I'm like, whoa, whoa, whoa. Why don't you build on it? Sell each property, build a nice big home on it, sell it for 500,000, make your profit of 200 on each parcel rather than just, here's the land. And so that can help you in terms of build inventory into like say like a local community of yours.
Yeah.
And that helps a lot of that's basically what NVR and all those guys do. You're just doing it at a much smaller scale.
Sure.
And you're pocketing the money yourself because you own the land. So that's another way to make
little guy
money.
wins there.
Yeah, little guy wins. So and we, my bank does we do owner builder here in Pittsburgh. So if you build your own homes, we'll work with you on that as well. So
awesome.
But yeah, just little things like that you find that banks do that you don't realize can generate and help and alleviate.
When did you guys start with that?
We've always done it.
Oh, you've always done it. Okay.
Yeah.
I don't know if that was just to kind of.
Yeah. Well, I really didn't get into it until this past year, and where I've really delved into the numbers, the fee structure sheets, how to do it, what you got to do to move the process along, and it's pretty unique. I will say that, and it's just a way for you, your agent, pretty much everybody to make money. That's just one way to, it's real estate.
Yeah, for sure. I want to pivot back to something that you had mentioned. I don't know if it was before this or during our discussion here. You talked about just interest rates, right? And what the Fed is doing. Obviously there's a lot of chatter around what they're doing. You had said, look, rates were the same. It's funny because my first duplex I bought, back in, I think it was 17. I want to say it was like 5.75, 5.5, and here we are. The rates dropped dramatically and now spiked back up really quick, and that's what you had mentioned. So, what do you see the Fed doing? How do you see?
Well, so first and foremost, I don't know what they're going to do, right? I can make a guess here, and I'm okay doing that. That's but the watching the way that the interest rates have moved. If you put it on a chart over time for the past 5 years, and I think I had said this earlier, was in 2017 we were all the way back where we are now, right? But we slowly got down to 2.625 or whatever on a 15.
Yeah.
Now if you look at it, in less than a month and a half, we've already shot up. We've lost all that 4 years and 9 months prior, almost in the blink of an eye, which is, to me, it's pretty crazy because the property values are the highest they've ever been, right? The banks are making money hand over fist. The economy is based on all points.
Inflationary environment too.
It's inflationary, and based on all points, it's doing well. The bond market's doing well. The stock market is up, since 2017. Everything is up since 2017. By all accounts, the rates should be somewhere in the threes, based on estimations.
So why do you think they're not? Is it to counteract inflation? I mean, is that?
In my personal opinion, this is just a personal opinion. Is I think the Fed, is trying to make their money back, from when they cut it all the way to zero lending, and that's, you'll see little basis point increases here and there from like Fannie, Freddie, the Fed, and right now my bank is lending, we do our ARM rates, I think on a owner occupied, I think today we went to 3.5 for owner occupied 5/1 fixed rate ARM. So that's well below where the market is right now, but that's because we also lend our own money.
Yeah, you guys do all portfolio lending, right?
Yeah,
so you guys are keeping it in-house?
It's in-house. It's 50-50 is what we do. So we keep usually about 50% of our loans in-house. If we have to go fixed rate conventional, you're going to be under Freddie guidelines.
Their guidelines, yeah.
Yeah, and Freddie is hitting the bank with, basis points behind the scenes that nobody ever sees, right?
Yeah.
Kind of like the secondary market. If we sell anything to FHA, we're already getting hit for half point, stuff like that. It's already baked into the rate.
Right.
So that's what you're seeing is, basically they're trying to make their money back, and FHA has made, for the first time in its entirety, made almost $2 billion for the first time. It was,
Yeah.
it was losing money up until last year.
Yeah.
So you're seeing just money being made by a lot of banks, a lot of entities.
Sets a precedence moving forward, right?
Yeah, I mean, if you're looking at it and you're seeing it, and it's like, well, is our income going to be reflective, like, your W-2 employees, is that going to be reflective of what's happening?
Right.
Are you going to see corporations pay their employees more money so that they can afford basically to live, essentially?
Sure.
Whereas, like, you're going to have your investors who also have their mortgages to pay and who are, going to be struggling as well. But you're going to see a step in where the rate is not going to go above a certain point, in my opinion. I think you're going to see where, hey, we can't let these rates go to 15% or whatever. They're probably going to stop them at 7%, if I had to guess. But I also guessed that by the end of the year, we were going to max out at 4.5 on a fixed rate. We're at 4.75, 4.875, depending.
Yeah, it's crazy. Oh, I referred you a buddy of mine.
Yeah.
And literally from Friday to Monday, boom. I mean, what was it? It jumped up like
quarter
point. Yeah.
Quarter point.
Jeez. Yep. Yeah. That's crazy. Now, and another thing I wanted to touch base on is second home finance. Do you guys do a lot of that? Do you guys do a lot of that at USB?
We do, but it's not. I would steer you away from second home financing because you're getting hit with a ton of points. Mm-hmm. And recently, second homes are going to be treated more or less like investment properties for the most part.
As of the change.
Yeah. So I was always kind of steering people more towards our portfolio product because here's the thing: if you're on our portfolio product, our rates have been fairly steady, even though they're adjustable rate mortgages. They've been fairly steady over the last 32 years that my bank's been open. We do kind of follow the market, but right now we're over a point ahead of the market. So it's kind of like, well, what do? Do you are you going to, be strong when you're making that, taking out that mortgage? Are you going to do it as an arm and, save yourself the money for 5 years straight? Or are you going to take the hit because that's where the market is, right? Mm-hmm. There's always a bank out there that is going to save you money at a certain point of whatever it is you're trying to do. It's a matter of finding that bank is the difficult part, right? Like you were just saying earlier about the QM bank statement loans that you were just like, holy cow. But
I'm willing to pay because I'm willing to pay for access.
Right.
So if I'm lower money down, because traditionally you with second home loan products, as you know, you're 10% down. And the rates were better than investment rates, right? Now, I think they caught on to see what people were doing.
They did.
I don't blame them. I don't put them at fault. So it's like, all right, wait a second. We see what you guys are doing. You're doing the Airbnbs and the Verbos and all that stuff. And, we're taking ours. So I get it. But for me personally, though, like it doesn't, I would much rather pay less, especially if you're talking about a $500,000-$600,000 condo in Florida. That rate, that's huge. That's a huge jump. Yeah. Huge. But for me, I mean, it sucks, but I'm going to buy the access, just because, I'm going to save more in terms of the down. Obviously they're charging points and that sort of stuff, which, I think there's ways around that. It's negotiable,
It is. You can,
to a degree.
To a little bit of a degree, you can maneuver your rate. You can buy down your rate or you can buy up your rate, which,
I bought, in that case, they had said that it was, they wanted to charge me 2 points at 4.75 recently. And I said, well, what about if I just go to 5.25? And they go, well, then you're good.
Yeah.
You're free. You're not paying anything. You're not spending $12,000 extra to buy it down. You're going to just pay a higher rate. I'm like,
but had you not asked that, most of your average loan officer isn't going to suggest it because a lot of people, because it's such a competitive market and, between banks, those loan officers are hesitant to push your rate up because they're afraid you're going to say no, right?
Yeah.
And so that's where you just kind of have to have, confidence in your bank, right? I know I will survive the coming wave, right?
Right.
Overall, inventory's low. Loans are all dying. Like they're all coming. Pipelines of every loan
What do you think
officers
it's going
are
to
coming
take to
down.
get that back?
Inventory.
What's it going to take for people to want to? They're not going to do it when they know that if I sell this, I'm going to be paying a lot more for something that's quite frankly not as nice as what I just sold.
Right. Exactly. And a lot of people are they tell me, well, I'm just going to sell my home and buy. And I'm like, why would you do that? Like you're putting yourself back into a market that's like completely volatile right now. Which, you may not like the house you're in, and the value may be way up right now, but the house that you're looking to buy, its value is going to be way up right now. So, and some people are like, well, I'm just going to sell and wait for the market to cool off.
Well, I know people that did that, and you're waiting 2 years.
Waiting 2 years, yeah. So it's, you never know what the market's going to do, unfortunately. But, with confidence, I can say that buying a home or buying investment properties is always what you want to do. Always. It doesn't matter what the rates are. The rates are going to go up. The rates are going to go down.
So do you view buying investment properties as an inflation hedge? How do you feel about that?
I think buying real estate is stronger than, say, putting your money in the stock market, in my opinion. It's going to grow. It's going to, eventually it's going to be it's always an asset no matter what.
Everyone always is going to need a place to live.
That's right.
There's only so much land out there.
Well, let's put it this way. I just read a weird fact. I see these all the time as like weird facts of the day. If you are aged 45, you have seen the United States population double.
Wow.
And that 45, listen, I'm 36. So I'm like, well, so it's in my lifetime, we've seen, I recall when the 300 millionth baby was born, and now to think that we've already approaching 400 million people. What I'm getting at is those people are getting older. Those people need places to live. Yeah. The country is expanding. Mm-hmm. We just still are on pretty much the same framework of housing here in Pittsburgh since 1920. You know what I mean? So
you're right.
It's like if you have somebody that's building homes, they're going to do well. Are they building them fast enough at the rate that people are moving in? By the looks of it, no, it doesn't seem.
No, and it's even worse down in like Florida. They just can't keep up. With that sort of thing. It's crazy across the board, regardless of what market it is. And I think that, to your point, if that's about the 45 years old and the U.S. population doubling, I think that's why I have a buddy that lives in, he got relocated down to Kansas. In the Midwest, like out towards the central part of the country, it's starting to really boom. There's a lot of development that's taking place because most of that's all rural. It's untapped land. It's
just land. There it is.
So when you think about it, you're like, geez, obviously, like there's certain parts out there that are mountainous and, you can't really do much, but a lot of farmland, that we use for those sorts of things. But by and large, there's nowhere else to go in New York City, right? Right. There's nowhere else Florida, they're growing and they're trying to keep up with it. But by and large, that's why a lot of people are relocating to Texas, Kansas, Missouri, some of those other places just because of that.
That's exactly right. And a lot of the advent of COVID has really kind of put a spotlight on people working from home too.
Sure.
So I've had people reach out to me from like New York who have been like, hey, I want to live back in Pittsburgh because the cost of living.
I don't want to pay $3,000 for 400 square feet.
Right. So they're calling me and they're like, "Hey, I want to move back to Pittsburgh." Well, what do you do? Oh, I work in New York City. I'm like, well, are you like at home, working from at home? Is that what you're doing? And usually it's a yes, and they're like, yeah, I can live wherever. And it's like, okay, that is really kind of opened up to, allowed people to just kind of push to these rural areas where it's low taxes, lots of land, they can pretty much be anywhere in 10 minutes.
Sure.
And, and it's kind of nice, in my opinion. But, for people like me, I'm kind of stuck.
Yeah, I'm not saying I would want to move to Kansas or Oklahoma, but I could see the appeal, especially for companies or just, in general, people wanting to get out of the craze and mayhem of, Manhattan and those sorts of areas. But yeah, no, look, I appreciate you hopping on. I think it was very helpful. Your insight's always appreciated. And for any viewers that want to get a hold of Dustin, you have a social media handle, or how do you?
It's this thing right here.
Right there,
That's
yeah.
it.
Just send me a DM and I'll give you his number. Be easy on him.
Thanks, guys.
So thank you all for tuning in today. We'll see you next week.
All right.